Hello, guys. Good evening. Um, okay, we're going to look at. Okay, kindly confirm that you can hear what I'm saying if I continue. Okay, good. Okay. What we're discussing here.
Don't mind. It's okay. I'm in a meeting.
So, guys, we're going to discuss what you already know or actually have an idea on, and this is partnerships. Okay, I'm going to give emphasis to business income as well, so that we don't have to hold another clinic for it. Now, a partnership is just a modification of the business computation as far as taxes are concerned. That for businesses, we have what you call chargeable income, and you're aware that we normally use the profit before tax as the figure. Okay, so to begin with, under business income, we get profit before tax, and then we add, maybe from yes, add from here, we're saying for business income, okay, can increase this size. So I was saying that for business income, when you're computing the business income tax, what you call the corporation tax, we begin with profit before tax. Okay, whatever you have. Then on that, you add what you call non-allowable deductions or non-allowables. And then we less allowables. Okay, so I'm going to explain this just for us to appreciate it. Okay, this is business tax. So ideally, this format is something you're supposed to know and just get fond of. So what I can do is maybe explain each item the way it is. Now I'll start with the first line, which is profit before tax. Now this line, in case they give you net profit or profit for the year, where they have already deducted the tax, supposed to use profit before tax. How do I mean by that? What I'm saying is, if you're given, say, I'm just creating a scenario. If you're given, if they say you have profit, okay, by now I hope you are familiar with the income statement, and therefore whatever right here shouldn't be an issue. Okay, so you have profit before tax, okay, before interest and tax. For interest and tax, say 20,000. Okay, and then you have interest expense, or like we call it in accounting, or OFM, we say finance cost. Assuming it is maybe 5K. Okay, and then you have profit before tax. This will be 15,000, the balance. And then you have the tax. In case you have tax here, tax purposes, it means that this was a provision that they did. Okay, I hope you guys are reading returns. So here maybe it's 10,000. That was your provisional tax that you had put. And then you have profit here. I'm saying if they give you something like this will be 5K. If they give something like that for tax For tax purposes, if you come to our format of business income, okay, I'm saying that usually they will give you the profit for there. Yeah, they'll tell you profit for there is 5,000. And then they'll tell you in the middle had a provision of 10,000. So at the end of the day, you have a profit for the year coming first. But I'm saying for business income tax purposes, you must get what you call a profit before tax. Because after all, our aim is to determine the tax that you're going to pay. So if you have any tax that are included in here, they're saying it's not supposed to be the actual expense. To just say the provisional, actually it's always a provision. So for us to compute the actual tax, we remove the provisional tax expense and have ourselves a profit without any form of tax being paid as far as corporation tax is concerned. And then then we add accordingly, we add non-allowable and then deduct allowable to come up with chargeable income. So I'm saying in this case, for example, here we're given profit for there. What would happen is you don't have this line, so you have to find it on your own. Okay, so what happens is you bring the profit for there. Profit for there. There it is, there it's 5K. Okay. And then you add back any provisional tax. In this case to be the 10,000. So at the end of the day, you have profit before tax. This will be the 15,000. Okay. Then now officially that's when you begin now doing the adjustments. By going into the expenses, you look at what is allowable, what's not, then you add and deduct accordingly. Okay, so I hope we are together as far as profit before tax is concerned. Okay, so now I'm going to explain the non-allowable. How does it come about? Now, for non-allowable, how we end up adding back and usually adding back, the issue is as follows. Non-allowable, we have two items. Non-allowables. Okay, I'm saying we have two items. We have what you call incomes. We have incomes and then have expenses or deductions. Expenses stroke deductions. Okay, so which ones do we usually take as non-allowed? You can respond to why do we add tax provision? We are adding back the tax provision. The reason is as follows. That while we're doing all this computation, we want to determine the chargeable income. And for us to get the tax liability, we get the chargeable income and attach the rate, the 30%, to determine the tax payable. Okay, or the tax expense, actually, the actual tax expense. So why we add back the provision is we are saying this provision is not the actual tax. Okay, there's an actual tax that is supposed to compute. So we are adding it back with the intention of having a profit without any form of tax deducted from it. Okay, so that we compute the actual tax that you're supposed to pay, and then that's when we shall recognize the tax expense. Okay, I hope I've answered you. Whoever asked about the provision, we add it back because you're saying it is not the actual expense. So we want to get chargeable income so that we determine the actual tax expense. Right? So back to what if you are given tax after tax? Profit after tax. What do you do to arrive profit? So what I've just done here, Karim. I don't know, I've just joined late or something. So what I've just done. Okay, our aim is you must start with the profit before tax. So if you're given profit after the year, here is the thing. That profit after the year is 5K. We're adding back the provisional tax so that we get the profit before tax. Okay, Karim, I hope we are together on that. Then back to non-allowables. Okay. So why do we normally add back non-allowables? The thing is, for non-allowables, we have two items. We have incomes and expenses. What you're familiar with is the expense. Okay, that why we normally add back, for example, depreciation. The reason is clear. That you have profit, we have gross profit. Okay, then you have operating expenses. Okay, then within the operating expenses, you have depreciation. Maybe you have distribution costs, okay, among others, and then you have profit for there. Okay, assuming we didn't have interest, we didn't have tax. So we're saying that the gross profit, assuming it is 40,000, okay, then your operating expenses, you have depreciation of maybe 10,000. Then you have distribution costs, say 15K. Okay, we're saying it to be 25, so you have 15 as left as your profit for there. Okay, so what you're saying is you have this profit, but you have a figure or an expense that you incurred in form of depreciation that is not supposed to be there. It is not allowed for tax purposes. Okay, so if this figure is not allowed for tax purposes, the one that the accountants compute, they leave alone the wear and tear. Okay, the one that we compute usually where we use our own methods. Is it straight line? Is it reducing at whatever rate we have? So for tax purposes, we say that depreciation is not allowable or is not recognized by URA. So we must have a profit, therefore, that does not include this expense. So at the end of the day, the only way you can restore 15K so that you have a profit without the depreciation is when you add it back. Okay, when I add back depreciation, the 10K, I'll have a profit, or what you call chargeable profit. Chargeable income of 25. Okay, I think the idea is clear that if you just close your eyes, or maybe if you're supposed to cancel out this depreciation, if you cancel it out, you will see that you have 40,000 minus 15,000, and you have 25,000. So the idea of adding back non-allowable deductions, expenses particularly, is you want to have a profit where such an expense wasn't deducted from. Okay, so that's the idea of adding back the non-allowable deductions. I hope we're together there. Now I can explain the one-off incomes. The one-off incomes, it is allowed here only on a condition that it isn't part of the profits. If it is not included in the profits. Okay, that on this profit of ours, if I'm just taking back, let me first remove this one now. I hope we are covered with that. Now we have an income statement like this. Then in the additional information, they're telling you I already shared it in the group. Okay, and apparently I'm just giving a scenario. It's not the real question. Shakira. Okay, so I was saying, now you have such an income statement, and they're telling you the additional information. We have maybe a sale of maybe 20,000 that has not been recorded. Okay, it's a normal sale. It has not been recorded. So what happens is we have to, of course, the only way this profit can show up with that profit or with that sale is when you add it back. I add back the income that I'm saying, the normal income that I'm missing out, normal income of say 20,000. The only way you can have a profit that includes all the incomes is when you add back that profit, that say whatever you need to recognize. This will be 35,000. Okay, I'm saying that this gross income here, there is an income that they have not recognized yet. So instead of dropping down this whole thing and you remove and you begin afresh and you say gross profit, then you include the income. You say the normal income was here. Let's say it was other income. It was other income, okay, and then you bring the 20,000 so that you have now gross income of 60,000, okay, from which you will deduct the deductions or the expenses to end up with the profit of 35. Of 35, we are saying you don't do this. Okay, you don't break down the entire profit or loss statement just in the name of putting in one thing that is missing. Okay, so what is missing, just add it on the end profit. Right? So that's why under non-allowable, you'll find there incomes that are not included in the profit or loss. Okay, and yet they are supposed to be there. We shall come and add them. And then expenses that are in the income statement or part of the profit, and yet they were not supposed to be deducted. Okay, so we add it back also. Okay, that is non-allowable. I hope we are together. So I'm now going to the allowable bit. Now for the allowable, why do we deduct? Okay, here, our performer. We're saying, why do we deduct allowables? And this is the reason. We're saying for allowable, why we less is one, you have incomes still. You have incomes and still you have expenses. What we call deductions. Okay, guys, please kindly mute whenever you're joining. So I was saying for incomes and expenses, when do they become allowable? Okay, so for income, we said we less them if they were part of the profit or loss. Okay, if they're part of the profit or loss, and yet they're not supposed to be there. What we call exempt incomes. Okay, if you find exempt incomes were part of the profit, okay, part of the figures to come with the profit, assuming our exempt income is this one, the other income. Now this has become exempt income. It's part of the figure, and that's why you have the profit of 35. And we're saying this figure here, the 20, is not supposed to be there, okay, because it's an exempt income for tax purposes. You come and less it, okay, so it qualifies to be under allowable or allowables, less allowables. That is how incomes end up being. That for an expense, supposed to be part of these expenses, whatever the case may be, but you didn't record the item. We're saying you come and deduct it. Okay, that is the technique of the whole thing, allowable and unallowable. Okay, so unless you have any questions, we are going to go to. Okay, I'm saying for allowables, incomes come here on a condition that they're exempt incomes. These are exempt incomes. Okay. But that's not enough. They're exempt because they are part of the profit or loss. Okay. If they are part of the profit or loss, for us to end up with this profit of 35, which we're going to use in our computation, we are saying the only way this profit can be normal or can be chargeable is when you have removed this exempt income. Okay. This exempt income is not allowed for tax purposes. Tax does not recognize such an income. So therefore, our profit can't be 35. We have to remove the exempt income. That's how it ends up being unallowed. So I'm saying here we will say less. If we begin with profit for the year, we're saying you less exempt incomes. Okay, so at the end of the day, we'll have how much is that? 15,000. Okay, let me put the figure first. It is 20,000. Okay, and then you have now profit or chargeable. Chargeable profit. Balance is 15,000. Okay, and I'm saying this one here, you can do it by restructuring this whole thing. okay, and end up with the same answer. That if I remove this exempt income and I remove it, okay, assuming we are removing it now. If I remove it manually, if I remove it, it means that my gross income will also be 40. Okay, and when I deduct the allowable deductions, I'll end up with the 15. Okay, so this is how the exempt income ends up being under allowable. I hope we're together. Okay, so I'm going to now attempt the question that we have so that we just have a feel. Is pardon on VAT. I've not talked about VAT, Matov. Okay, I've not talked about VAT, so I don't know if I've said VAT. So we continue. So back to the question. Okay, so you're given such a question. It is a partnership, but you allow me use it for business purposes, and then I'll talk about the partnership together. Okay, because they're the same thing. If you know business, then you know partnership. That's my idea or my argument. Okay, because they apply. Okay, there are a few differences, but ideally is no much difference in my opinion. Okay. Expenses, pardon, labor. For expenses, I've said that if an expense is allowable for tax purposes, and yet it is not included, okay, since we are covered with incomes, okay, I'm saying there is an expense that occurred during the year of income of, say, maybe you spent on salaries or commission, okay, 50,000, but it was not recorded, and therefore your profit here is overstated by the fact that they didn't record that expense. We're saying you come and bring it here. Okay, let's if it's a commission, for example, it's 5K, so that you get the normal profit or the chargeable profit that has all allowable expenses and all taxable incomes. Okay, so Jackie, I hope I've answered you on that. Okay, so allow me to go back to what I was saying. So this is the question. It is like you know, they give you the income statement. Okay, then they're saying, so for purposes of business, we are going to close our eyes on the interest on capital and partner salaries. Okay, so if I skip those, don't wonder why am I skipping them. Okay, so we're just saying that these are not part of our business. Okay, because this is a partnership. So what we do is, like I already told you, you begin with the net profit before tax. Okay, so if there was anything like tax here, then you'd have to make adjustments. But since there's no tax expense, you just begin with this net profit here. Begin with it. So I'll just put the solution. Let me remove this that I put in the middle. Hello, I don't know if you're asking the question or you're speaking to someone out there. So we're saying that the solution is
it's okay. Like
guys, could you please mute? So I was saying, this is my Excel, I'm going to use it. So let's start responding. Okay, so as my Excel responds, so we're going to start with the net profit, then make adjustments accordingly. Okay, so net profit. Okay, maybe someone can share with me the figure in there. Okay, feel free to contribute as we move it. feel free to contribute. So the net profit is 372,500. Okay, that's my net profit. Now we're saying if you had any tax, you would have to add it back so that you get profit before tax. But we don't have it. So we add back what you call non-allowables. Okay, and then shall less allowables. Okay, now on adjustment, we have two formats. I don't know which one you prefer, but two formats. One is if you have an adjusting item. Let me first get there so that I use a case study. Now I was a bit confused. It's okay. All right. So you come and look at additional information first. Okay. So our note one says that sundry expenses comprise the following. So you have a staff Christmas party, trade magazines, day release, courses for staff, general lab expenses, and subscription to buddies scheme. Okay, so all these items, in my opinion, they're supposed to be allowable. Okay, but a subscription to buddies, I don't know what it is personally, so I don't know that anybody has an idea what it is. So I would remove it because I don't know what it is. But assuming to a subscription to maybe a trade union, or to a regulator, okay, in that regard, those subscriptions are allowable since they're helping us run the business. But this buddies scheme, to me, it feels like you have buddies or friends whom you maybe did business with, and now you have decided to start maybe a circle or something, or a scheme. Okay, so and I'm saying that's not a business transaction. Okay, so since because it's not a business transaction, you're supposed to remove it. Okay, now I'm saying there are two ways of doing this. One is you get this item, you see this sundry expense. If you check part of your profit or loss, you'll find that sundry expenses are part of the expenses, and they're 16,000. Okay, so we're saying part of the 16,000, 1,400 is not allowed or is non-allowable. Okay, so someone would say, let me just add what? The 1,400 since it's non-allowable. Clearly able to see that. And I'm saying you're fine once you do that. Let me put that here. Saying subscription. Okay, by this scheme. 1,400. I'm putting it here because it was part of the expenses and reduced my profit, yet it's not supposed to be there as far as tax is concerned. Dan, feel free. You can say something. Yeah. Okay. Now done. Christmas party. We can go under our lab expenses. You'll find there's something we call staff entertainment. Those expenses are allowed. Okay, so Christmas party can't be disallowed. Obviously, it can't. So you can only find another one. Done. I hope we are together on that. That anything to do with staff entertainment, it is allowable for tax purposes. Okay. Actually, it's under meals, entertainment, and is it welfare, staff welfare, something like that. So you'll find that those expenses are allowed for tax purposes. So for subscription, why I'm saying it is not allowable, I've tried to explain to you, and I hope you got it. But I can repeat since the mere fact that you said otherwise means you didn't pick what I said. Okay, I was saying that subscription to buddies, we don't know that circle, we don't know that entity. Okay, if it was subscription to a trade union or how do you call it, or a regulator, okay, like it is now, like for mobs, if they're subscribing to the higher council of education, that is allowable for tax purposes. Okay, but if they're subscribing because maybe now, like if Mobs and Makerere have that kind of scheme or circle and they're subscribing to that, to it, I don't know for what reason, that can never be allowable for tax purposes. Okay, so guys, this link is going to close, I think, in a few seconds. So you join with the same link. It's going to close just shortly now. So join with the same link. Christmas cannot be linked in aspect of business problem unless the taxpayer can prove that it was incurred. Wholly. What do you mean it was incurred wholly? Because like I said, for stuff, for anything to do with stuff, as long as it's not spent on an individual alone, it is allowable for tax purposes. Done. That's what I think. So